Welcome to the Wealth Wisdom, where knowledge becomes power and power builds your future.
Imagine being told your entire life that interest rates are simply an economic tool, a lever used to control inflation, stabilize markets, and keep the economy healthy. A technical adjustment, a harmless percentage, a minor tweak that economists debate on television while everyone else shrugs and carries on with their day. But what if that was never the full story? What if interest rates were never just numbers, but weapons? What if they were instruments of control so powerful that they shape the rise and fall of nations, decide who becomes wealthy and who stays poor, and determine which countries dominate the world and which collapse into crisis? And what if the true purpose of interest rates has been hidden behind technical language, academic jargon, and false explanations designed to keep the public from understanding how deeply their lives are influenced by decisions made behind closed doors? Because the real mystery begins here. Who truly benefits when interest rates rise, and who benefits when they fall? Why do the same patterns repeat across history? Booms followed by painful busts, prosperity followed by recession, easy money followed by crushing hardship, as if someone is pulling the strings? And why does every major interest rate decision seem to shift wealth upward, squeeze the middle class, and tighten the system around ordinary people? To understand all of this, you have to go back to the very beginning, to a time when interest was not just an economic tool, but a moral question. A time when societies debated whether charging interest should be legal at all. A time when interest wasn't seen as a neutral number, but as a tool of domination. Long before central banks existed, interest was considered dangerous. Ancient civilizations like Mesopotamia, Greece, and Rome all saw how easily lending could turn into exploitation. Farmers would borrow seeds at high rates, fail to pay, and lose their land. Families would fall into debt bondage. Wealth would concentrate in the hands of a few lenders who controlled the entire economy. Some societies banned interest altogether. Others capped it. Even religious texts across Judaism, Christianity, and Islam warned against excessive interest because of the social damage it caused. But something changed in the late medieval and early modern world. Commerce exploded, trade routes expanded, merchants grew rich, and empires needed capital. Interest became too profitable, too useful, too powerful to resist. Slowly, quietly, the rules were rewritten. Charging interest became normal. Debt became currency, and lenders became kings. But the real turning point, the moment interest rates became tools of global control, came with the birth of central banking. The story begins in 1694, when England, drowning in war debt, created a private corporation with a strange name, the Bank of England. In exchange for lending money to the crown, the bank received the power to issue currency. And with that power came something even more influential: the ability to set the first modern interest rates. For the first time in history, a small group of financial insiders could tighten or loosen the flow of money for an entire nation. They could create booms by lowering rates. They could trigger crashes by raising them. They could reward borrowers, punish savers, or reverse it at will. Interest rates were no longer a private contract between lender and borrower. They were national levers, economic weapons. More central banks followed: France, Germany, Japan, and eventually, the most powerful of them all, the United States Federal Reserve. Born in 1913 after secret meetings on Jekyll Island, where a group of bankers and politicians drafted a plan to centralize control of the monetary system. The public believed it was about stability, but history shows something different. From the very beginning, interest rates were used not just to manage economies, but to shape them. To understand how this power evolved, you need to look at how interest rates interact with money itself. When rates go down, borrowing becomes cheap. People buy homes, corporations expand, governments spend more, stocks rise, economies boom. But when rates go up, the opposite happens. Debt becomes heavier, payments rise. Businesses cut costs, people delay purchases, markets fall, and economies slow down, sometimes violently. This cycle is not accidental. It is engineered, and it creates dependence. Because when an economy becomes addicted to low interest rates, as most modern economies now are, raising them becomes a weapon that can trigger recession, collapse industries, and reshape political power. But to see how deep this rabbit hole goes, follow the timeline. In the early 20th century, the world experienced rapid industrial expansion. New factories, new technologies, new markets. Money flowed freely, but with growth came instability. Markets overheated. Speculations skyrocketed, and in 1929, the world saw what happens when interest rates are used carelessly. The Federal Reserve raised rates to cool speculation, but instead ignited the most devastating economic collapse in modern history, the Great Depression. Banks failed, businesses evaporated, millions lost jobs. And while people blamed capitalism, greed, or panic, very few realized the truth. A small shift in interest rates triggered a global collapse. Ordinary people suffered. While powerful institutions bought assets for pennies, wealth didn't disappear. It moved. After World War II, interest rates became even more strategic. Nations rebuilt under the Bretton Woods system, where currencies were pegged to the US dollar, and the dollar was pegged to gold. But as governments spent more, especially the United States, during the Vietnam War, something had to give. The system strained. Inflation rose, and in 1971, President Nixon ended the gold standard. Money became pure debt, and interest rates became the ultimate tool for controlling that debt. Over the next decade, inflation spiraled wildly. Prices doubled. Currencies destabilized. The world entered a crisis. And then, one man stepped forward to reshape the global economy. Paul Volcker, chairman of the Federal Reserve. In 1979, he made a decision that shocked the world. He raised interest rates to nearly 20%. The result was brutal. Millions lost homes. Businesses collapsed. Unemployment soared. But inflation died, and a new world order emerged. One where central banks proved they could crush the economy at will. This was the moment interest rates became openly weaponized, not just for economic stability, but for discipline, for control. Governments learned to fear central banks. Investors learned to obey them. and citizens learned that their financial lives could be transformed overnight by a rate change they had no vote in. From the 1980s onward, central banks mastered a pattern that would define the modern economy, lowering interest rates to stimulate growth and raising them when inflation appeared. But each cycle came with consequences. Each drop in rates encouraged more borrowing. Each rise in rates caused more pain. Debt grew exponentially, and soon, entire economies depended on rates staying low. Then came 2008, the Great Recession, when the housing market collapsed under the weight of toxic mortgages. Central banks around the world responded in a way no one had ever seen. They cut interest rates to zero. They flooded markets with money. They bailed out banks. They saved the financial system. But at a cost. After 2008, a new kind of dependence formed. 0% interest rates fueled massive borrowing. Corporations borrowed billions to buy back their own stocks. Governments borrowed to fund deficits. Consumers borrowed to survive. Asset prices exploded. Housing, stocks, crypto, everything rose. It felt like prosperity. But it was an illusion built on cheap money. And here's the dangerous part. Once an economy becomes built on endless cheap debt, raising interest rates becomes a weapon that can destroy everything. The world learned this again in 2022. When inflation surged after pandemic stimulus and supply chain shocks, central banks responded by raising interest rates at the fastest pace in modern history. Suddenly, mortgages doubled. Businesses laid off workers. People struggled to pay bills. Banks collapsed, like Silicon Valley Bank, which failed because rising interest rates destroyed the value of its bond holdings. This is the hidden danger of the system. When interest rates rise, the value of old debt collapses. Government bonds fall. Corporate bonds fall. Housing markets slow. Stock markets shake. Nations with high debt struggle to survive. Raising interest rates becomes a bomb detonating across the financial system, which raises the question, if the risks are so obvious, why do central banks still raise rates so aggressively? Because interest rates are tools of discipline. They force governments to control inflation. They force corporations to cut costs. They force workers to accept stagnating wages. They force the public to lower their standard of living during inflationary times. And they protect the financial elite, those who own assets, by preventing runaway inflation that would erode their wealth. And there's something even more unsettling. Interest rates are often used geopolitically. When the US Federal Reserve raises rates, capital flows out of emerging nations and back into the US, strengthening the dollar. Countries like Argentina, Turkey, and Pakistan face currency crises, soaring import costs, and rising poverty. They become dependent on international lenders, like the IMF lenders, who demand strict conditions. Privatization, spending cuts, and political reforms. Interest rates, in this sense, become global weapons, reshaping economies far from American shores. You see this pattern throughout history. High US rates in the early 1980s crushed Latin America, triggering the lost decade. Rate hikes in the 1990s contributed to the Asian financial crisis, and recent rate hikes have devastated dozens of countries. pushing them into debt traps. Meanwhile, wealthy nations benefit. Investors earn higher yields. Banks profit. Governments strengthen their currencies. And corporations acquire distressed assets in struggling countries. The same tool, a simple percentage, creates winners and losers on a global scale. But interest rates don't just shape nations. They shape people. When rates rise, mortgages become unaffordable. Young families cannot buy homes. Rent increases. Car payments rise. Credit card debt becomes suffocating. Dreams get delayed. Life gets smaller. Entire generations become trapped in financial survival mode. When rates fall, asset owners become richer. Housing prices rise. Stocks rise. Those who already have wealth multiply it. The gap widens. This is the real purpose of interest rates in the modern world. To regulate the distribution of wealth. Over time, lowering rates benefits asset owners. Raising rates harms wage earners. The middle class gets squeezed between both. But the question remains, why does this system repeat the same cycles over and over? Why do we see booms caused by low rates and busts caused by rising rates? Because the system is built on debt. Every dollar created is debt, and debt requires interest, and interest requires someone to pay. As long as the system operates this way, interest rates will always be weapons, tools, that decide who thrives and who struggles. Now we stand at a dangerous turning point. Global debt has reached over $300 trillion. Nations cannot afford high interest payments. Corporations cannot refinance their loans. Consumers are drowning in credit balances, and yet interest rates remain high, not because the economy is healthy, but because the system requires discipline. And here's the twist too few understand. If rates stay high for too long, the global financial system risks catastrophic failure. But if rates fall too quickly, inflation can explode again, destroying savings and destabilizing economies. The world is trapped between two dangers, both created by the same tool. This brings us to the modern parallels that reveal the repeating pattern. Every major crisis in the last century to 1929, 1980, 1997, 2008, 2022 shares the same sequence. Easy money, rising debt, overheating markets, inflation or speculation, sudden rate increases, collapse. The pattern is mathematical, predictable, engineered. The question is no longer whether interest rates are weapons of control. The question is, who controls the weapon, and for what purpose? As we reach the end of this journey, here are 3 takeaways you must hold onto. First, interest rates are not neutral. They are tools of power, capable of restructuring entire economies and shifting wealth on a massive scale. Every rate decision affects your life, even if you never think about it. Second, the global financial system is designed around debt. As long as money is created through borrowing, interest rates will always function as levers of control, tightening and loosening the system to maintain order. Third, cycles are not accidents. Booms and busts are predictable results of engineered rate changes. Understanding this pattern is the first step to protecting yourself. And here is your warning. The next decade will test the global economy like never before. Government debts are soaring. Central banks are cornered. Inflation is unstable. And interest rates, once technical numbers, are now the most dangerous weapons in the world. Pay attention to every rate announcement. Understand who benefits. Understand who suffers. Because these decisions are not made for you. They are made to preserve a system built long before you were born. If you found this eye-opening and want more deep explanations about money, power, and the system shaping your future, make sure to subscribe, share this video, and join the conversation. The next video will expose the truth behind the global institutions that dictate economic reality. Stay aware, stay curious, and don't let the system control you without understanding how it works.